things are getting out of whack with respect to the amount of money being burned? What's the current landscape looking like?
I think you'll
धंधा इज यार अगर कॉस्ट 8 रुपए 10 रुपया है, यू हैव टू मेक 12 रुपया एंड 2 रुपया घर लेके जाना है. आई मीन व्हाट इज दिस लॉजिक ऑफ नॉट मेकिंग मनी?
Ladies and gentlemen, Zepto is going IPO to raise 8,010 crores of fresh capital at a reported valuation of $7 to $8 billion. And some bankers are whispering that it could stretch to $10 billion. And looking at this figure, $10 billion, the market is buzzing with excitement and skepticism at the same time.
Remember, Zepto is the latest entrant, plus the fastest growing.
Zepto has done really great. With a short period of time, it has created a lot of market share, killing all the demarts of the market.
Zepto delivers groceries in 10 minutes, but can it really deliver profits?
Zepto at the moment is burning the most cash amongst the three.
On one side, the optimists say Zepto is a crazy company. Their app didn't even exist 5 years ago, and they went from 0 to 22,624 crores of revenue. They deliver 640 million orders a year. Their advertising engine now prints 1,636 crores, and they convinced CalPERS, one of the largest pension funds on the planet, to write a check at a $7 billion valuation. And they're already processing nearly twice the orders of Swiggy Instamart. But the skeptics say that Zepto is a cash-burning machine. While Blinkit is almost profitable with an average order value of 525 rupees, Instamart stands at 504 rupees per order, whereas Zepto barely stands at 388 rupees per order. On top of that, Zepto lost 5,905 crores in FY26. And the scary fact is that even in its best quarter, I repeat, even in its best quarter, Zepto still lost 59 rupees on every single order. So they are practically paying money to make you order. Now let me introduce you to a company called DMart. DMart sells the same things Zepto sells. In FY26, DMart earned 2,970 crores of profit on 68,821 crores of revenue, and the market values it at 3.79 times its sales. Now, if you look at Zepto makes a loss of 5,900 crores, and depending on where this IPO prices, it's asking for anywhere between 2.7 to 3.9 times its sales. So, a loss-making 4-year-old is asking for DMart's multiple in the market. So, is Zepto the Amazon of Indian markets that will one day print money, or is it the most beautifully packaged cash-burning trap ever sold to the Indian investors? Well, to answer that, we need to answer 3 questions. How did a 4-year-old company burning 5,905 crores a year convince the market that it is worth $7 million? Is there any version of the math where a Zepto order actually makes money? And should you, the retail investors, put your money in this IPO or run away from it? Before we move on, let me introduce you to today's sponsor, Scalar School of Business. People, what will build a strong India won't just be bold policy bets, it'll be the business talent that will back them. But India's education system is so messed up today that even after 4 years, 35% of engineers and 30% of MBA grads are still unemployable. And with AI rewriting how companies operate, ideally all MBA colleges should be teaching students to build products and companies with AI and not just case studies. That's exactly where Scalar School of Business stands out. They run an 18-month full-time business plus AI program in Bangalore, which is built and taught by leaders who have scaled billion-dollar companies like McKinsey and BCG. But what stood out to me is the outcome of this program. Within months of joining, students have built D2C brands generating over 15 lakh rupees in revenue. They've launched over 10 plus AI products with paying users, and 6 startup teams have also raised pre-seed from VCs while still in college.
My team will fund you. 50 लाख में कितना equity देगा?
Students here also work on real-world company-sourced projects guided by the very leaders running those companies. Just recently, they built GTM decks to scale Practo's revenue in India, and they pitched it straight to Practo's CMO. This is the kind of feedback that no classroom can give you. In their founding batch, students achieved an average salary hike of 3.2x and landed leadership roles at companies like Urban Company and Blinkit. So if you want to become a brilliant business leader, apply to SSB's next batch starting September 18th with scholarships up to 50%. Link is in the description. To understand the money, you have to forget the app and you have to follow the average order value backwards. The first thing you need to understand about Zepto is that it's not a delivery app. It's not a marketplace either. It's a retailer. Swiggy connects you to a restaurant and takes a commission. That's a marketplace. Now, why does that matter? Because when Zepto reports 24,815 crores of revenue, that's the full price of the groceries flowing through its books. Divide the total order value in the prospectus by the total orders, and every order carries about 388 rupees. Now, Zepto earns from that order in three ways: the margin on the products themselves, the fees you pay, which includes delivery, handling, and Zepto Pass, and the advertising money from brands. Put all three streams together and subtract what Zepto paid for the goods, and you will see that Zepto keeps 18.56% of every order on a 388 rupees order. So that's about 72 rupees per order. That's the actual money that is left with Zepto. Now let's look at the cost that Zepto incurs. Here there are two costs: fixed cost and variable cost. Fixed cost is the money that Zepto spends whether or not you order anything today. For example, the dark store's rent does not care if it fulfills 10 orders or 1000 orders. This also includes store staff salaries, cold storage, central overheads, and all fixed expenses. And the best part about fixed cost is that as the order volume goes up, fixed cost per order comes down. For example, if the rent of a dark store is 3 lakhs and it fulfills 1 lakh orders, that's about 3 rupees per order. Double the orders and it drops to 1.5 rupees per order. Last year, a Zepto dark store used to do about 1,279 orders a day. Today, it does 2,140 orders a day. But even with double the order volume, Zepto has to pay the same rent for the same shelves. And because of this, Zepto's fixed cost per order has crashed from 80.72 rupees to 52.34 rupees. This is the story of the fixed cost. If this is clear, let's come to variable cost. Variable cost is the money Zepto spends on every single order. This includes the rider, the packer, the packaging, and the mid-mile truck. Now please remember, whether it's one order or 1 million orders, this cost always shows up in every single order. The prospectus calls this the supply chain variable cost. And today, it's about 64 rupees per order, of which pure delivery and handling is roughly 48 rupees. And then there's the third bucket that most people forget, and that is marketing. This is the cost that Zepto incurs for every ad that Zepto runs to make you download the app. A year ago, Zepto was spending almost 34 rupees per order just on digital marketing. But today, this cost is down to just 4.31 rupees. So they've basically stopped paying for the customers because the customers keep coming back on their own. If this is clear, let's do the math. If you add fixed costs and variable costs, the prospectus says Zepto's total cost per order in FY26 was 150.71 rupees or 151 rupees. So Zepto earns 72 rupees per order and spends 151 rupees per order, which means across FY26, Zepto lost about 79 rupees on every single order. Let me say that again. Zepto lost 79 rupees per order 640 million times. But look at this. The loss per order is drastically coming down. In the January to March quarter alone, that loss had already fallen to 59.4 rupees per order. 1 year earlier, the same loss was about 143 rupees per order. So the loss per order has more than halved in just 12 months. So now, we call this the 59 rupee problem. And every chapter of this case study henceforth is really about whether Zepto can actually bring this 59 rupees to zero. Because the day it goes from minus 59 to plus 1 rupee, Zepto stops being a cash burning machine and starts becoming a money making machine. So the question is, how Zepto plan to take this 59 rupees to zero, and does the plan even make sense? Well, Zepto is pulling 3 levers to close this gap. For those who don't know, in 2015, Wall Street was mocking Amazon for its razor-thin retail margins. Then Amazon revealed the hidden business growing inside it, which was AWS. And overnight, the market realized that a low-margin retailer was secretly running one of the most profitable machines on the planet. And a few years later, Amazon did it again with its advertising business. And every retailer platform since then, whether that is Zepto, Blinkit or Instamart, they are running the exact same playbook. Use the boring thin margin store to build the audience and then sell that audience to the brands. And Zepto's version of this is genuinely stunning. Look at this ramp. In FY24, they were making 49 crores from ads. In FY25, that number climbed to 651 crores. In FY26, that number climbed to 1,636 crores. In fact, if you look at it quarter by quarter, Zepto went from 1 crore a quarter to 543 crores a quarter in just about 3 years. Now, why do I call this the most powerful lever? Because when Hindustan Unilever or Nestle pays Zepto for the ad, there is no rider, no warehouse, no wastage. And industry estimates put these margins on the lines of 90+%. So it is the closest thing to free money in this entire business. Now let's connect it to the 59 rupee problem. Remember that 72 rupees that Zepto keeps per order? The ad money is not on top of that. It's already inside it. Ads are a part of Zepto's revenue. So they are baked into that 18.56% margin that we calculated. Now, when you break that 72 rupees open, look what's happening inside. The ad contribution per order has gone up from 4 rupees in FY24 to 20 rupees in FY25 to 26 rupees in FY26. So the groceries are the thin part and the ads are the fat part. And that fat part is growing very, very fast. So the real path to profitability looks like this. That 26 rupees growing inside the 72 must push Zepto's take per order from 72 rupees towards 85-90 rupees while reducing the cost from 151 rupees to maybe less than 100 rupees. And when these two lines meet in the middle, Zepto will become profitable. So this is amazing, isn't it? Zepto is just about to become a money machine. Well, before you get too excited, do this one piece of math with me. For ads alone, to close this 59 rupee gap, ad revenue would need to hit roughly 85 rupees per order. On a 388 rupee order, that means 22% of everything you buy would be advertising money. 22%. No retail platform on earth is anywhere close to that. And this is where I think there is a ceiling. I think pushing this ad income further will be very, very difficult because of what we saw firsthand when we ran our quick commerce accelerator program. We saw that most brands on these platforms barely make 5 to 10 rupees in profit per product. And mind you, this profit is CM2. It's not net profit. It still has to pay for the brand's own fixed costs before anything counts as profit. Now let me show you the math. Let's say your product sells for 200 rupees. The making of the product or COGS takes away 30%. Quick commerce platforms trade margins range between 20 to 40%. So let's consider it to be 30%. So that's about 60% of your revenue gone. You are left with just 40%. And then you have tech, payments and logistics, which will take another 5 to 8%. Eventually, you are down to roughly 32%. So from 200 rupees, you are down to just 64 rupees. And wait, there is more. On quick commerce, if you don't advertise, you don't exist. So ad spend eats up another 20 to 35% of the revenue for most brands. And that is how 64 becomes 5 to 10 rupees. So in quick commerce, a brand making 10 rupees per order is also considered to be a legend because many are at zero and some are bleeding money. Now let's connect the dots. Zepto has two fat income levers, the trade margin that it squeezes from the brands and the ad money that it charges those brands. Both come out of the same 64 rupees. So if the platform squeezes either of these levers, the brands will start bleeding money. So out of Zepto's three income streams, trade margin, ads and fees, two are capped by the survival of its own suppliers, which leaves only delivery and handling fees. Now it's completely dependent on the customers whether they're okay paying more and more in delivery fees. So the question is, can Zepto cut costs instead? Because there are only two ways to grow, right? You either increase the income or decrease the cost. That is how you close that 59 rupee gap. Well, now that you've looked at the income, let's look at the cost. Let's open up that 151 rupees cost side and ask line by line what can actually be cut. The first line of cost that we have is the rider and packer cost, which is about 61 rupees per order. The prospectus calls this supply chain variable cost. And over 3 whole years, this number has moved by just 2 rupees. It has come down from 63 rupees to 61 rupees. Now, do you realize you can't slash it by paying riders less because it becomes exploitation after a certain point? Now, let's look at discounts. Zepto has already reduced discounts a lot, so you cannot reduce cost here by a large extent. Then we have marketing. Here, digital marketing cost per order crashed from 34 rupees to 4.31 rupees in a single year. But that also means that there is very little left to squeeze. And lastly, there are payment gateways, tech and server costs. Now, if a company has to reduce these costs to achieve profitability, it's a terrible business. So do you realize what just happened? Every easy cost lever has already been pulled. The variable cost has almost hit the floor and the discounts are gone and the marketing is at just 4 rupees. So the question is, what the hell is actually left? Well, the game is in the fixed cost. Right now, the fixed cost per order is at 52 rupees. After peaking at 87.71 rupees during expansion year, it has crashed to 52 rupees in just 4 quarters. And every order added to an existing dark store costs the same rent and same salaries. This is the last big lever on the cost side, and it only works if order volumes keep on climbing. But even here, there is a cap. A standard Zepto dark store processes an average of 2,140 orders per day, which is very high. And as per my industry conversations, the ceiling of a dark store is about 2,500 orders per day. So do you see the reality now? The 59 rupee gap looks very easy to close on paper, but in reality, the cost side alone gets Zepto from 59 rupees down to maybe 25 to 30 rupees. But the problem is, after that, it stalls. So the question is, will Zepto never be profitable? And is this IPO just a polite exit door for the investors? You know, when I made my last case study on quick commerce, this is exactly where my research failed. I assumed that Zepto and Blinkit would keep selling groceries forever, and in India, getting an AOV above 500 rupees on groceries alone is a mammoth task. What I failed to consider was that AOV can be boosted in 2 ways. Either by changing the category or by nudging the same customers to add more to the bag. First, let's get the numbers right and you'll understand this very easily. And by the way, before you get into this, just a disclaimer, every platform reports AOV differently. Some include taxes, some include ads, some include delivery fees. So if you compare the press releases, you're comparing apples to mangoes. So let's do it the honest way. Let's take each platform's net order value from January to March quarter and divide them by orders. Let's use the same formula for everyone. If you do this, Zepto stands at 361 rupees per order, Instamart stands at 504 rupees per order, Blinkit stands at 525 rupees per order, and Flipkart Minutes apparently stands at 750 to 800 rupees per order. Now, by the way, this is a reported number and we don't have a disclosure from the company itself. Okay? Now, if you look at this graph, Zepto has the smallest average order value in the entire industry. And let me show you why that average order value matters so much. Imagine a Zepto rider on a scooter. He picks up your order and drives to your house. That trip costs Zepto what, 61 rupees, which includes rider, packer, packaging and mid-mile truck. That's the supply chain variable cost that we spoke about. And on top of that trip, the order also carries a fixed cost, which is about 52 rupees, which includes rent, salary and cold storage. So the total cost comes out to be 115 rupees per bag. Now here's the game changer. That 115 rupees is almost exactly the same whether the average order value is 361 rupees or 550 rupees. So it's the same scooter, same rider and the same shelf. Now ask yourself a simple question. Is it better for Zepto to send that scooter with a small bag or a big bag? Obviously a big bag, right? So on an order of 361 rupees, that 115 rupees eats 32% of the basket. But on a big bag whose average order value is 550 rupees, the same 115 rupees eats only 21%. So the cost did not fall and the average order value shot up. And that is the entire insight. If the average order value of Zepto crosses 550 rupees and above, just like Blinkit, it will become borderline profitable. Now this is where the skeptics will tell me, Ganesh, explain this to me. Instamart's bag is 504 rupees, so Instamart should be printing money as compared to Zepto, right? But in FY26, Instamart also lost 85 rupees per order. That's more than Zepto's 79 rupees. So how will Zepto make money? And how does it work for Blinkit and fail for Instamart? Well, it's a simple one-word answer. Throughput. A Zepto dark store pushes out roughly 2,140 orders a day. Instamart stores barely touch 1,100 orders per day. Now, do you remember the 52 rupees of fixed cost? The fixed cost goes down as the store processes more and more order. So this number is small only when the store processes orders at a scale of 2,140 orders per day, because fixed cost reduces with increase in the number of orders. So if you look at the honest formula, it's very simple. High average order value into high order volume is equal to profit. Blinkit has both. Instamart only has high average order value and Zepto only has high order volume. So obviously Zepto's plan, I am assuming, is to push its average order value from 361 rupees towards that magical 550 rupee mark. And the day it does, Zepto will get very close to profitability. Now, whether they do that by selling appliances or by nudging customers to add more products to the cart, only time will tell. So now, after listening to this entire story of Zepto, you know the strengths, you know the weaknesses, you know the loopholes. So the question is, should you invest in Zepto's IPO? Well, standard advice, I am not a financial advisor and you should never take financial advice from me even if I give it. What I can tell you is that you must read the DRHP and make an informed decision. I'll attach the link in the description. And always remember, do your own research and consult a registered expert before investing in anything, whether that's a stock or a house. That's all from my side today, guys. If you learned something valuable from this case study, please hit the like button to support our work. And for more such insightful business and political case studies, please subscribe to our channel. Thank you so much for watching. I will see you in the next one. Bye bye.